Welcome, grade 10 learners. Today is the 23rd of May, 2026. That is the time that you are preparing to take your June examination. So I've decided to revise with you the June examination, which was written in Gauteng province. That is for grade 10. This is the provincial examination, meaning that it is written in by all Gauteng. So I've decided to revise with you to prepare you for the exam. So without wasting time, let's dive into it. So this paper is 2.5 hours, and it covers all the content that you have learned from January up to the last topic of second term before you sit for the examination. So these are the topics that are covered. Concepts and analysis of transactions. This is the basic concept of accounting and analysis of transactions. Then the general ledger, then the general journal, which is a new topic that you have learned from grade 9. Then we have the creditors reconciliation and concepts and salaries. Let's go through the question paper. Let's start with the concepts and analysis of transactions. This is a fairly simple question where you are required to match the concept in column A and the description that is in column B. So let's go through the question. Column A says 1.1.1 have fixed deposits. So if fixed deposit is an asset that can be long term, it can be short term. So money that is deposited into a fixed deposit account is an investment. So now, which give us on the portion that you're given here with money that is invested with a financial institution for a certain period of time. It can be 1 year, it can be 3 months, it can be more than a year. So that's a fixed deposit. So the answer for question 1 is letter C. Then the next question. Internal controls. So these are measures that are taken by your business to prevent the loss of assets. Those are internal controls. So it would detective measures, with preventative measures. So the answer that we are going to the answer that is available here is letter C. Internal controls are measures put in place to ensure smooth running of the business. So it's letter K. The next question. Petty cash. Petty cash. Petty means small. So it's a small amount that is kept in a safe. A safe is the box that is locked and kept at a safe place. So the answer that matches with petty cash is A. Petty cash, a small cash amount kept in a lockable money box for making small payments. So petty cash, as the name suggests, see, petty means small, meaning that it's this a small amount of cash that is used to make small payments. Usually these small payments, we only have to borrow withdraw cash from the bank or to transfer money via EFT. So we have to keep a small amount of cash within the business. This matches with A. Then the next question is bank overdraft. What is a bank overdraft? A bank overdraft, it is when the bank allows you to withdraw more than what is in your account. You don't already have sufficient funds in your account, but the bank is going to give you that allowance to take more than what is in your account. So what does it mean now? What it means now is you've got a liability. You're now owing the bank for the money that you have taken, which you used, and your account didn't have any amount. So bank overdraft 1.4, it matches with A. Thus B. A facility granted by the bank to borrow funds. The funds borrowed are owed to the bank. So it matches with B. Matches with B. Right, the next question is 1.2, analysis of transition. This is a fairly easy question. In this question, you're going to, in 41 marks, analyze the following transactions according to the headings provided in the answer. The business uses a markup of 75% on cost. Assume that the bank balance is favorable for all the transactions. So let's look at the example. The first example is given here. It says paid 10,000 rands by EFT to Cox, a suppliers for store purchased. Now we generally record this transaction and the account to be debited, the account to be credited. Then the amount, then the effect on the accounting question. How does it affect assets, owners, equity, or liabilities? That is the account, the basic accounting equation. So here over the general ledger, we debit accounts such as assets, drawings, and expenses. We credit capital, liabilities, and incomes, meaning that these accounts they increase on the credit side, and drawings, assets, and expenses increase on the debit side. And the first question, 1.2.1, sold goods on credit. The cost price was 700 rands. So we are given a question like this. Here they say sold goods on credit. So now we have to think which general cloud who recorded this transaction. In this case, goods were sold on credit, and there's no man that was received immediately. So this transaction is recorded in the data's journal. Journal. And the account that is going to be debited. So here we have two sets of double end that you are going to effect, because whenever stock is sold, we must reduce the trading stock, but we also have to show the sales with the selling price, then reduce the trading stock with the cost price. So this is done using two sets of double ended. The first one is with the sales price, which is a debit, data's control, and credit, sales, credit sales. So to calculate the sales amount, we have to use the formula. Selling price equals to SP over a cost price multiplied by the SP. So in this case, we are giving the markup, which is 75% plus the cost, who give us the selling price percentage over 100 multiplied by a amount that we are given for the cost, which is 700. 700 rands. So this would give us a 175% multiplied by 700. And if we calculate, you're going to get using the calculator, gives 1,225. So that's the amount that you're going to show under the amount here. 1,225. So how does it affect assets? Data's control is an asset. When you sell goods on credit, it increases the data's control. So we are going to show with the plus. And sales aid and income. Incomes increase owner's equity. We are going to show with the plus one for owner's equity. Then liabilities, put to 0. So every time we sell the goods, we have to use the trading stock. How do we use the trading stock? We are going to show that this will be the cost of sales account, which is an expense. The cost of sales account, which is an expense account. So we debit cost of sales. Then credit trading stock. This is then with the amount 700 rands, which is the cost price. So the cost of sales is an expense. It's a reduced owner's equity, so it's a minus on owner's equity. Then trading stock decreased because you sold the stock, so it's a minus on assets. Then liability is 0. The next transaction is on this SQ being deposited 50,000 into the bank account as per the loan agreement. So the business applied for the loan, then the bank deposited the money into the business current bank account. So when the business received a loan, when they called in the cash receipt journal, and the bank account is going to increase, so debit bank. The moment that you take a loan, your liabilities decrease. So credit, loan is a liability from SQ and bank. So how does it affect assets? The bank account increased, and there no owner's goods liability also increased. The next question is a debit. A debit note was issued for damaged goods worth 2,100 rands that was returned to the supplier warrants. So a debit note is issued when you are returning goods to a supplier. So it accompanies the goods that are being returned to the supplier. Meaning that the trading stock is going to decrease because you bought the goods and then you discovered that the stock is damaged. So you can't do anything those stock are damaged. The only thing that you can do is to return to the supplier. So to return to the supplier, we record in the creditors allowance journal, and the source document is a debit note. So we say creditors allowance journal. So how is it presented on the double end? When you bought these goods on credit, so your creditors control is decreasing. So creditors control increase on the credit side because the liability. And when it is decreasing, it's decrease on the debit side. So we say debit, creditors control. And the trading stock that you have returned to the supplier has reduced the stock that you already bought. Meaning that the trading stock is decreasing and trading stock decrease on the credit side. So we credit trading stock. So how does it affect assets? You return the stock to the supplier. There's a minus on assets, your stock decreased. And your creditors control decrease. Creditors control is going to decrease because you return the goods that you bought on credit. So you're no longer owing the supplier of those goods that you return to the supplier. So it's a minus on liabilities. Then the next question is the owner is 1.2.4. The owner paid 1,800 rands to Atlantis club for years to this training the lessons. The owner is using the business the money to pay his personal expenses. So the account that is created is the agreement drawings. It's an honest which account to use honest. So we generally quote when you use a bank account to pay for the owner's personal expense. That's cash payment journal. Cash payment journal. So the account that is debited is 2 weeks. 2 weeks. In the account that is credited, his bank is an asset. It decreases on the credit side. So how does it affect assets? When the bank account decreases, assets decrease. And so when borrowings increase, on the sequence decrease. And liability is here. Right, the next question. The next question is 1.2.5. A receipt was issued to beyond for the settlement of his amount owing 7,200 rands. And a settlement discount was given to him. So in this case, we're saying, hey, customer are paid early. And the business gave a discount. So how do we show this with a quote in the cash receipt transaction? So first, what you have to do is we have to calculate from the amount that was being owed. We have to calculate which is the early settlement discount. So how do we calculate? To calculate the discounts is 2.5% of 100. 100 is this 7,200. 100% is $7,200. So what is 2.5%? 2.5% is 108. So what does it mean? What it means is the business gave a discount to Vion of 180 rands. So how much did Vion paid? Vion paid $7,200 subject 108, which is going to give him the 7,020. So to show this, we're got in the cash journal. So how are we going to show this? The bank account is going to increase the moment that cash is received. So we are going to be paying. And if your is a debtor who is paying for what he was owing, so the debtors control account amount is decreasing. So we credit debtors control with how much? With 7,020. $7,020 is the cash that was received. So how does it affect the assets increase when the business receives cash? However, the other asset that we are talking about here, debtors control, is decreasing. Debtors control is an asset. So when the debtor pays, the debtors control decrease. Both are assets. So there is no liability, there is no management. So we have to show the discount. The discount, early settlement discount, it is called discounts allowed. Discounts allowed. Discount allowed is an expense to the business. And because it is an expense, business should not receive anything, business should not get the money that it was supposed to get. The debtors control is decreasing. It is an expense to the business. So how much is the discount? It is 108. 108, how does it affect assets? As we said, discount allowed is an expense. So expenses are used on a stick with. And because the business gave a discount, and that discount, the business is not going to get any money from whatever the business may choose as a payment to the debtor, meaning that the debtor's control is also decreasing. Liability is zero. Liability doesn't affect the liability of this transaction. Then the next transactions is from on the bank. The main bank statement received from PAB bank reflected the following. EFT fees are expenses, 170 rands. Then credit card levies, 80 rands. Service fees, 90 rands. So how are we going to do with this? Using the materiality concept, we are going to combine all these expenses to form one account, which is known as the bank charges. So bank charges is an expense, and whenever the bank charges for the service that it is providing, the bank balance is going to decrease. So how do we show this on the accounting equation? This is recorded in the cash payment journal, and the account to be debited, it is a bank charges. So we are going to create a bank charges as an account for all these expenses. Then the bank account is going to decrease before the fee is going to that amount from the bank class. So how much, if we add all these amounts, if we add these amounts, it is 170, 80 and 90, 107 the rands plus 8 plus 90. So the bank charges amount to 340. So how does it affect asset? The bank balance decreased because of the charges. So it's a minus on assets. Then bank charges are expenses, then reduce on a stick with minus on assets. This transition does not affect the liabilities.